Welcome everybody, this is Brian here. We got Paul online. He's going to be doing a presentation on his new software that's currently being developed for the Poseidon and his latest research in topographic finance. Take it away, Paul.
All right, thank you very much for joining. Again, this is going to be about topographic finance or 3D finance, which is an easier way to look at it. Just an introduction of myself. I'm an author. I've written 3 books, basically about complexity science, behavioral finance, dynamic hedging, financial statistics, and chaos theory. I'm a chaos theorist, and I use this as a theoretical framework for my trading and my writing. I'm a proprietary trader. I focus on the energy and the currency markets, primarily because of the volatility of those markets. My dissertation topic is dynamically hedging oil and currency futures using receding horizontal control and stochastic programming. And the book that I'll be releasing this month, near the end of the month, is called Black Box, The Alchemy of Finance. And this is a little bit more about the financial statistics and setting up finance research, some of the methodology behind it. Okay, what is topographic finance? It's the study of financial and economic systems using 3 dimensions or 4 dimensions. Now, in 3 dimensions, you could use, let's say, a typical volatility surface would use volatility, strike price, and time to maturity. That's one way to look at it. You can add another dimension to give it some more movability over time. It kind of morphs. This type of methodology it provides insight that lower dimensional visualization cannot capture. So, for example, on the chart on the left, this is the typical price chart. This is for Autodesk. I don't remember for what year it was or whatever, but it's just a simple 2D price chart with some volumes, and it gives you somewhat of an indication of how these different stocks are performing together. But there's more information in a 3-dimensional object or a 4-dimensional object than you would normally have in a price curve, a typical price chart. And that's what I'm basically trying to convey with these 2 charts here. It's the 2D chart on the left and the 3D chart on the right. You can convey more information to a trader or to someone that's studying econometric analysis in 3D. So it can be used for trading and financial or economic analysis. So what problems can be visualized? Well, if you start from the econometric point of view, you can take a look at this. You can look at unemployment in time and GDP and see the relationship between unemployment and GDP through time. Now, normally when someone builds up econometric models, they're doing regression analysis on multiple independent variables. So, for example, GDP might be partially related to exports, imports, taxation, capital expenditures. So when you do this regression analysis, you get some statistical significance on certain independent variables that basically provide some predictability with the dependent variable. So what I'm basically saying here is to say you can graph some of the highly statistically significant multi-factors and 3-dimensionally look at them together in time or in some other dimension and be able to discern a little bit more information than just a normal 2D graph. Another example is tax rates over time and tax revenue. Now, the ones that have joined that are familiar with the Laffer curve is is basically tax rate relative to tax revenues. And it was proven that if you keep on increasing your tax rate, tax revenues will actually decrease. If there's a negative feedback loop at some point, there's a topping off, and it starts to actually hurt the tax revenue. So, what you can take a look at this in time and actually develop a Laffer surface. So this is one way to use topographical finance or topographical economics. Now, for financial information, you can take fundamental data, for example, PE ratio, and compare it to time and the revenue growth rate. And you would get some sort of three-dimensional understanding of those variables if they're statistically significant. For a technical or a quant trader, you can take a look, and that's what primarily this webinar is focused on, is the idea of looking at price, time, volatility, or what I talked about a little bit earlier about the volatility surface, strike price, time to maturity, and volatility. So those are some of the sorts of problems that could be visualized in 3 dimensions or 4 dimensions. So what can surfaces provide? It can provide an easier way to interpret the data. It fills in the gaps with a theoretical or probable state space between the points that are used to parameterize that surface. It can be used with 2D visualization for confirmation. So in this webinar, I'm going to show with Poseidon on one side of the screen and normal price trading chart on the other side of the screen, and they can augment each other. Now, here's some of the theoretical framework that kind of ties into the previous lecture that I did last week on complexity science. So again, I'm a chaos theorist, and I focus primarily on chaos theory. And there are some sub-themes in chaos theory. One of those sub-themes is complexity science and the idea of emergence. So what I'm showing here in these 3 pictures, starting from the left, is the dark spots are selling traders, and the white spots are buy traders in the market. So on the left is a pretty much homogeneous, nice mixture of buyers and sellers in the market, and not too much clustering between them. It's not lumped, so it's pretty homogeneous. So the market is in equilibrium. But there is a case where there is some sort of critical mass, and groups of traders start mimicking each other. So in the second diagram, in the center, you start seeing that the white spots and the dark spots are coalescing. So buy traders are starting to mimic each other, while sell traders are starting to mimic each other. It just so happens that the number of dark spots versus light spots in the second diagram are equal. So the market is still in equilibrium, just like the previous diagram, but it's less homogeneous because there's lumping, but there are equal buy and sell traders. But there's a critical point where I'll use the word metastasize, but there's a critical point where either the buy or the sell traders, it runs away, or what I call escape velocity. And in this case, on the right, you have the buy traders actually bubbling up the market, and it goes, it takes off. There's either a jump diffusion, or there's some sort of power law in terms of the rate of growth of the price, and eventually there is some sort of crash. But I just wanted to show the theoretical framework of Poseidon is this idea that you can kind of sort of predict the market based on the homogeneous homogeneous makeup of the market, and look at volatility as one major metric. There's others during the development of Poseidon. I'll show them, but this is basically the theoretical framework behind it.
Paul?
Yeah.
Casey's got a question. He wanted to know what the axes of the diagrams are.
Well, we'll get to that.
Okay.
All right. So the story of Poseidon. I only have a few more slides before I go into Poseidon. So the story of Poseidon is that Poseidon is one of the 12 Olympian deities of the pantheon in Greek mythology. His main domain is the ocean. He's called the god of the sea. Originally, he is referred to as the earth shaker due to his role in causing earthquakes, and has been called the tamer of horses. He's usually depicted as an older man with curly hair and beard. So the idea of Poseidon, why I named the software Poseidon, is because we're trying to model the market and show the wave pattern in 3 dimensions of the market. And you can almost kind of imagine the trader is the boat, surfing the wave that Poseidon actually creates. So let me tell you a little bit about Reykjavik. Reykjavik is my research lab and basically my prop trading firm. And basically I'm developing Poseidon through the research of Reykjavik. I live in Lower Manhattan, very, very close to the Freedom Tower. So that's a little bit about Reykjavik. Now, Poseidon. This is a surfacing software. It's designed by Reykjavik, which is the company that I own. Its ethos, its basic mission, is to provide the financial industry with a surfacing tool to produce, analysis of econometric and financial data, provide a predictive set of tools for quantitative trading, and allows traders to manage risk and understand the volatility graphically. So that's the main mission for Poseidon. Now, a little bit of the future development before I show you what the current development is. This kind of ties into this complexity science that I was talking about a few slides before. Poseidon is moving towards the direction of crash prediction. Crash prediction not only at the macroeconomic bubble kind of phase, but also in the intraday, traders that trade regularly, especially the intraday traders. They kind of have the sense that there is kind of like these mini bubbles that happen throughout the day, and then they crash or mean revert. A lot of models use mean reversion type techniques to determine buy-sell conditions. Well, there are other methods that Reykjavik has been playing around with, and some of these methods are using what is called a log periodic fitting method, and it's basically taking 2 years, in this case, daily data. So you're really only looking at years here. You're not looking at, but you can apply this to other time frames. But most of the research out there is using daily data, but it could be used for intraday. And the concept is that you're fitting for 2 years using a log periodic fitting function, and based on that function and understanding the parameters, what causes what's the endogenous signal, you can predict ahead of time when the gas is going to run out for the bubble. So using this as a predictive tool to put more positions on a hedged leg, this is the direction that the site is going. So that's one method, using the log periodic fitting method. So the chart on the left is showing 2 years worth of data being fitted in that method, while the middle chart is showing 8 years of data showing the log periodic fitting method. Now, way to do crash prediction is to take a look at out of the money options, or what is called the skewness premium. And you're looking at the 4% range for those. And those are usually picking up more volatility than your in the money options. For 4% away from those options. And I don't have a chart for this, but there is such a thing as hazard curves, and using hazard curves to use crash prediction. Now, so basically, the idea here is topographical finance can visualize the market. It can be used, with existing trading systems. It can be used for historic or as well as predictive analysis. And futures research is basically, for Poseidon, is going to be big data analysis or polyglot analysis. Streaming surfaces for visualization using tick data. And then with this crash prediction, the buildup of an AI system or an artificial intelligence system. So that's basically the PowerPoint presentation. If anyone has any questions before I start getting into Poseidon, I probably should take those.
Anybody got any questions, I guess? Just type them up in the chat box. I'm just sitting here waiting for the questions to come in if you guys got any questions. A couple of questions came in. I think Jag asked, how did Poseidon work in predicting the recent January volatility run-up?
Well, I've been doing the research in the back end, building the software. I didn't use it to predict that correction that hit the 100-day moving average. Poseidon actually was developed shortly after that happened. And it was actually some conversations between Brian and another trader that usually is part of the forum here.
Yeah.
And we were talking about volatility and how to graph it, and that basically spawned the idea of Poseidon. So, if there's any other questions,
I got two more. Kuz asked a question. You wanted to know what those axes were, if you're still going to address those now or in the future.
I will. I promise.
Okay, Ian's got a question. We'll be very interested in hazard curves for a future webinar.
Yeah, this is really cutting edge stuff that's coming out of Zurich, and it's really cool stuff if you believe that you can model an endogenous risk of the market, which I do. I believe that you can. Even though I'm a chaos theorist, I believe that there's endogenous risks that builds up in the system that you can model and use it as a predictive tool. There are existential events that are outside the model that cannot be predicted, but at least the endogenous part of it can be. So this is really cutting edge stuff.
Anybody else got any questions right now? Before we get into the fun stuff. It doesn't look like it, Paul.
Okay. All right. So if someone wanted to download Poseidon, there's many ways. Some of the webinars or the videos that I've created on YouTube or Quant Labs has links to it.
Yeah.
But if someone wanted to get the latest version, all they have to do is go to the studio, Reykjavik.com, right here. And they just go down to, it's all free. I don't charge anything. So I go data files public.
You might want to put that in the chat box too, the exact link.
Yeah, well.
So it'll help out people so they can capture that. Another question just came in from Jag. Get that in a minute when you're ready, Paul, if you want to take it.
Okay. So once you hit that link that I just put in the chat box, or just go to the website and go to data files. You just scrolls down. This is where I put my webinars, some of the market analysis that was taking place shortly after the the correction, the S&P 500 correction. This is before Poseidon was being developed. Here's some beta testing of Poseidon in these PowerPoints here. But to actually download the software, it's all free. You just click the server link, and what will happen is it goes to a shared Dropbox, and I update this regularly. So here's all the data of Poseidon as of right now. There are 4 data files, the Excel data files. There's an install text instruction. There is the MCR. Now, basically, Poseidon is running on a MATLAB engine right now. But the whole intent is to move this into a little bit more quicker platform.
Java.
But just for getting the bulk of this working quickly, I'm using MATLAB. So to run these standalone applications, everyone would have to install this MCR. I only code this right now for a Windows-based system that's 64-bit. I'm not going 32-bit. This thing takes way too long for that. So it's for people that have 64-bit machines that are Windows-based. This software is available for free. I will be having one for the Apple, but there's a little bit of a technical hurdle on my end because I upgraded my my operating system, but I'll solve that soon here. And then there's these standalone applications: Poseidon, Poseidon Oil, Poseidon Longview, and Poseidon 10-year. So Poseidon 10-year note is the 10-year treasury note. Poseidon Longview is 20 years of the S&P 500 data, showing it in a graphical form. Poseidon Oil is showing the oil contract, current oil contract, and Poseidon.exe is just the S&P 500 1 year worth of data. So you download this, you install it, So once you do that, and you follow the directions, you put it in your C drive and your program files, and you install it. This is what you have. This is what you basically get. So what I'm going to show is the S&P 500 and the oil market tonight. So basically what Poseidon gives you is an Excel sheet. And the data that I am looking at currently is obviously the time frame, the adjusted close, the simple return, which is just basically, this minus this divided by that, and then the log return, the square of the simple return, the square of the log return, the volatility of the simple return, the volatility of the log return, the drift of the simple return, and the drift of the log return. So the debate is, well, do you want to look at simple return or log returns? So I've been playing around with it. I came to the conclusion that it should be log returns, but other traders may feel more comfortable using simple returns for doing their analysis. But when Poseidon gets a little bit more advanced in terms of menu structure, you'll be able to pick any asset that's in the database or one that you want to build up yourself and pick which types of returns or what you want for your three-dimensional view. Maybe you want to just look at the adjusted close and the drift with the adjusted close. I mean, Poseidon will be able to do that for you, but for all my testing purposes, this is the kind of the matrix of data that I wanted to look at. So to answer Kuz's question about the chart, Poseidon right now is basically taking for the X the time, for the Y it's taking the log drift, the drift log, and for Z it's taking the volatility of the log return. So basically, once you can take a look at, oh, what was today? Today is 310, and if you wanted to take a look and adjust this matrix, you could easily just make an insert a line. You could go to wherever you want. If you didn't subscribe to my data feed, you could easily just go to Yahoo, just type in SPY, or however you get your data, and you can take a look at the historical prices. I'm just trying to show how you can build up a matrix without subscribing to a data provider. And you can see here that today's close, there's market data, where's the 10th? That's not updated, huh? Okay, but either way, you can basically just take the adjusted close here and just type it in and build up your matrix. So it's, it closed on the 7th at 188.26. I have that here, right here. But if whatever days that you want to update this chart, you can easily update it, calculate the simple return, the log return, the squares. I mean, people that are in trade, they know how to do this. What I do for simplicity, for the drift simple and the drift log, I use just a simple regression of the last 20 days. All this is 20 days moving window. Some traders will want a larger window. Some traders might want a shorter window. If you're a day trader, let me put it this way. If you look at the day chart for your trading, then you probably want around a 20-day moving window. But tick moving window. But this data is really just daily close data, for because I'm a spread trader in the currency, not currency, the energy market. Those types of contracts, you're not day trading. You're holding the position for at least a couple weeks. You do a simple line regression in the last 20 periods, and you just take the slope of the curve, and that's basically the drift of the log return or the simple return. So once you create that data and modify it any way you want, or just download the latest matrix that I put in the download section of Dropbox. I regularly update it, but right now it's just test phase. Then you can run Poseidon. So once you modify your data, and let's say we wanted to look at the S&P 500. So I just click this, and Poseidon is going to be generated. Now, Poseidon runs a little slower for some reason when I'm in that meeting. So let's be a little bit patient here. But while that is cooking, we can take a look at what other people normally do. This is an S&P. This is an S&P 500 index. Your computer is overloaded.
Yeah. Hey, Paul, if you need, you could just, maybe you could just use what you're trying to show in Yahoo Finance or something.
Just use what you're trying to show in Yahoo Finance or something. Yeah, wait a minute. this generates. Should have tested it for this webinar.
Yeah.
Just hold on.
Yeah, no problem. I can tell some jokes as usual.
Yeah, no problem. I can tell some jokes.
Anybody got any
Well,
questions?
somebody has some questions while this.
Yeah, Casey came up with a question.
Because there's a lot going on with this in the background that parameterizing surface. And once you see it, you'll understand why it's taken its little hose here.
But Casey wanted to know what period are you using for the volatility?
Right now, for testing, I'm doing a 20-day moving window. And then to parameterize, there's the data that you saw in the Excel sheet is 20-day moving window data. But when I parameterize the surface, I'm actually parameterizing it with 3 different time frames. One is a year time frame, a 60-day time frame, and a 20-day time frame.
Anybody else got any questions in the meantime at all?
Okay, here it goes.
Hooray for MATLAB.
It usually runs quicker, but because of this net meeting, it's...
Yeah. My computer's getting thrashed with SQL Server and MATLAB and Visual Studio. Holy moly.
Okay, so what's basically happening here is that what's happening here is it's generating a lot of curves, right? And a lot of surfaces. It's creating CDFs, or cumulative distribution functions, for different time frames. So that's what these are. All right, and then they are producing, besides producing PDFs, which is probability distribution functions, for the different surface time frames. So that's what these are. And then it's producing parameterized surfaces based on a certain data set of either 60 days, 20 days, or a year worth of data. That's what this set is. So there's 3 types of data that you're getting: surfaces, PDFs, and CDFs. Okay, so what we'll do is we'll take a look at, let's say, the year data first. So let's just hide that here. That's why it took so long, is it's generating a lot of stuff. Now the intent here is that I'm going to actually have a menu that says what you want to see, instead of it producing all these things at the same time.
How many data points is that spreadsheet?
It's a year worth of data, so it's 250 some points.
Oh, okay.
Now the 20-year data file is obviously larger. It's 250 some points times 20. I've tried that the max that I can surface this thing with the equipment I have is about 4,000 points or so, without it really taking too long.
Yeah.
You know, there's an upper limit with the hardware I have.
Casey came back with another question. If you want to take it, or
well, let me just kind of get this thing organized here, so I can explain what's going on. All right, so basically, and then I'll take the question.
All right.
So basically, what's happening here is you got these 2 different types of probability functions, right? And I don't know how many people are actually statistics kind of majors, or understand statistics well. But basically, what this is a way to have some sort of predictive ability of the market. Now, when Poseidon was originally developed, it was just to read the surface, and it didn't have all these functions on it. And some of the people that were helping me kind of like get a little bit better direction on how people can read this stuff, the question came up: well, how do they know that how to treat it? So there's the quantitative side here and the qualitative side here. So it's kind of a mixed method in how to read the data. So here's your volatility of the log returns, your time, and your drift of the log returns using a simple regression method to determine drift. You could get a little bit more complicated on that, but I mean, for this type of data, you don't really need to. You can see here that it's basically MATLAB's way of converting the date into a number. So this is 20 days, or what is this, 250 days, 250 days ago at this vertice, and this is current time over here. So all the points that are over here, around in this area, are actually the points that are parameterizing the current, the current condition, the current area. So when I look at this, I'm seeing that, well, there were very volatile situations many months ago in this data. That's what we're seeing here, the wave pattern. And there, during those epochs of volatility, there were big drop-offs. So you can almost use this as a qualitative indicator to say that when you have low periods of volatility, it usually lends itself to higher volatility points. So if you're an options trader, you're trading options that are a little bit farther out, not just the current month. You might, if you're in a low period in volatility, you might say, okay, I want to buy some volatility because this data is predicting a little bit movement up in volatility. Now, if you look at the current condition, the latest point is here. So when you look at the current condition, it's around here. So when you look at the other volatility points around it, it's saying, well, you know what, we're kind of in a lull period, so maybe volatility is going to actually creep up. Even if I look at the extrapolations of these surfaces, the areas where the points aren't, these are kind of like theoretical state spaces for the volatility and the potential drift areas. It doesn't mean that it'll be there exactly, but that's at least the theoretical relative to the parameterization of the surface. When I look at these points over here and how it's been trading down, the volatility's been down, they've been clustering around a zero drift range. That's telling me something's changing. All right, but this is year data, so it's a little, it has a lot of history in it. A year worth of history in the surface that's being developed. But just looking at the year history, I would predict, at least qualitatively, that volatility should start to rise. And when that volatility starts to rise, there's going to be a movement, either positively or negatively, with the drift. All right? That's just a qualitative measure. That's why you have the information on the right, which is showing quantitative measures. So CDFs are basically to show that here is your 0 point. Here's your 0 point for drift, right? So it's saying, looking at year data, that you have roughly about 0.4, so about 40% chance that it's going to be negatively drifted. And that, so it's kind of confirming what we were seeing in the data. Everything's clustering around the 0 mark for drift, but it does seem, based on this data set, that you only have a 40% chance that the next few weeks or so, that the data would actually push a negative drift for this asset, which is the S&P 500. that's how you would read. That's how you would read this CDF function. Now for the PDF. The PDF is like your standard distribution. So you can take a look and say, well, I want to, I have, here's the mean, it's roughly around here, is the mean. And you can see that there's slight skewness, which is confirmed here, of a positive drift. And you can use this in terms of 1 sigma, 2 sigma, or 3 sigma. So if you start seeing drift that's in the 3 sigma range in your current in the current price, then that would be a sell signal or a short signal, because statistically it will want to be a little bit closer to the zero point. So if the point is here, in your current in what's currently traded, then you'd want to short. If it's way over here where the current point is, the current price, then you'd want to long it, because if you were trading in the 3 sigma range. Now what Poseidon does is it provides this text file. So when you run Poseidon, it creates a text file, and you can open it. You can open it in WordPad. When you open it up in WordPad, this text file is actually giving you some quantitative measure for the 250-day PDF. It's saying what the average drift is and what the 1 standard deviation is. So you can basically say 3 times this number. If the price is above, short it. If the drift is above, short it. If the drift is below, long it. So that's how you could do algorithmic trading. You could, if someone has a system already developed, you could read this text file, put it into their algorithm, and make a trade. Use a trade. Either they could be a 1 sigma type algorithmic trader, or a 2 sigma, or a 3 sigma, or a 4 sigma. They can make that determination. But this is at least a window. Which is the damn thing that's down. But this is at least a window into using Poseidon for algorithmic traders, where it's actually not built into their software, but at least it has some sort of loose connection by reading the text file that's developed. For now, that's basically one way to look at it. Another way is to look at the PDFs for the volatility. In this demonstration, I'm only showing the drift. I haven't developed the code to actually generate the CDFs and the PDFs for the volatility, but it's relatively a simple exercise. I just haven't gotten to that point yet. I'll have that next week. But the point here is that you are taking averages and you're taking standard deviations of the drift of the log returns, or any other metric that you would want to use, and you can integrate that in an algorithmic platform. Or if you're not an algorithmic trader, you can still trade off of this information. And if you were a technical trader, you could take a look at the S&P 500 next to a price chart, which is what I'm going to do now. There was a question. What was the question before I started?
The question was from Casey. He asked, when you say 60 days, are you talking 60-day calendar days, a la
No, 60,
or trading days?
60 trading days. 60 days worth of trading data.
Okay. Do you want to take any more questions? See if I don't have anything yet queued up.
The reason why I picked the 60 days is that there's usually 20 days in the month for trading. All right, the reason why I picked the 250 days mark is usually, roughly, there's about 252 days of trading in a year. And then for 60 days, that's for people that want to trade 3-month contracts. So the 20-day mark is for people that are trading, 1-month contracts, 3-month contracts out for the 60 days, and people that are a little bit more longer-term traders, or at least want to understand the history, the year history. Then they want to look at the 250, mark for the trading days. Now, in the presentation earlier on, the PowerPoint presentation, I was talking about using log period fitting. Well, this surface is sort of it shows a wave pattern that's happening. And what Poseidon is going to do is start looking at not just 250, but 252 days worth of data, but 252 days worth of data times 2 and times 8. And based on that, it will start doing predictive analysis for crash. And it doesn't have to be day data. It could be tick data. It could be 252 ticks that are collected, or whatever time frame you want. 200 hour data collection. That's up to the trader what they want, how they want to build that up. I'm looking at it from spread trading point of view in the currency market, or not currency market, the energy market, and it seems to me that seems to be the correct parameters for at least the type of style of trading I'm doing. There are some people that are a little bit more higher frequency, and they probably need a lower window to take a look at. So hopefully that answers the question.
Yeah, we got a comment from Dave. He was asking about for crude oil on NYMEX, why 20 days is about the length of dependable trading patterns between contract and options rollover. But he's not seeing it not for SPY, he's not seeing it.
Well, yeah, I mean, like I said earlier on in this webinar, and maybe he didn't hear it, but I focus on currency and the oil and nat gas markets. I do help manage a large portfolio that's more of a past portfolio for a very large nonprofit organization in New York. We purchased the S&P 500, and we purchased certain bond ETFs to hedge the portfolio. But I don't do any spread trading or option trading in SPY. That would be someone that that's really a question to really be answered by someone that is an option trader for SPY.
Casey came back with how would you set up a spread trade based on the charts you just showed?
I'm going to go over that. Let's take a look at SPY first, and then we'll take a look at the oil market, and hopefully I can answer that question. So now I want to take a look at, let's say I want to take a look at the 20-day, right? Because I like looking at 20 days. But some traders may feel more comfortable to look at things at different time frames. And once I build up the menu structure for Poseidon, the trader will be able to dictate to Poseidon what exactly they want to see. I'm not in the business to say what you should be looking at. I'm just trying to build up the engine for everyone to just ask Poseidon, please give it to them. All right, now those are PDFs, and then the 20-day CDFs. All right, so first off, I'm going to take a look at, now I trade with many different screens. So what I do, it's kind of hard to show it on the webinar with just this one screen here, but I have, a lot of different screens. So I have some screens just dedicated for the surfacing. the PDFs, CDFs, while I have other screens that are dedicated towards the normal price charts. So, I can see all this at the same time, but I can't demonstrate that on this webinar. So basically, we got a surface that's 20 days parameterized, 20-day moving average, but the surface is parameterized with 20 days worth of data. And this is the current time frame right here. Noticing the clustering that we were talking about earlier, where it's clustering around the 0 point for the drift. So that's basically saying this is a mean indicator that even though this is kind of the reason why I want to look at drift and not price. This is showing how the price is moving up. Oh, great, the price is moving up. But in reality, because of this big drop off, and there's 20 days worth of parameterization for the drift factor, you really didn't have that much increase, drift, let's just say, relative to a 20-day moving window because of all this back and forth volatility. So you're basically broken even. But this chart here is kind of misleading, saying that, oh, you're actually doing well. In reality, you're not if you're looking at a 20-day moving window. But that's one way to look at it. Another way to look at it, all right, qualitatively, is the way this is parameterized. I'm seeing that this, looking compared to the previous days, you had higher volatility, right? And then it looks like it's extrapolated down, and you're going to have lower volatility in the next couple days or so, all right? And either way, based on this surface parameterization, if the drift went up or down, it would still be relatively low in volatility compared to 20 days ago. And that kind of makes sense. You're also seeing that these are small candles here. It also exacerbates the issue with the drift consolidating around the 0 point. So hopefully everyone's following me on that. What's also interesting is this is all happening at the same time that the MACD is starting to curl and the RSI looks like it's topping off. There might be a little bit more of a blip, but it looks like this is running out of gas. If you look, at least as a technical trader, these things have been touching off of the 100-day, breaking through the 50-day, but touching off on the 100-day, but never touching the 200. So I keep on thinking that, well, just looking at this chart, there should be a correction that's taking place, but there's been a lot of momentum, and maybe the only game in town is U.S. equities, and maybe that's the reason why. But it ties back into the PowerPoint that I showed with the traders, with the dots, the black dots and the white dots, right? Well, there's a lot of white dots that are starting to form here, and maybe we haven't reached critical mass, but it's looking like at least there's a definite momentum towards the buy side than the sell side. But that's usually a sign that there's a correction coming. So that's the qualitative measure here, what this is showing. Now, if I want to take a look at the some of the probability, if I take a look at the CDF, the cumulative distribution function, this is telling me, now this is an approximate fitting of the 20 points of data that are on the surface here. So basically this is saying that there's going to be roughly about a 30% chance of negative drift and a 70% chance of positive drift. So if you're just using this as an indication, then you can basically say, well, I can put in a buy signal because the probability of the next 20 days is that it's going to be positive drift, not negative. Only 30% chance of negative. So even if you wanted to do an entry, if you had a day, maybe a little bit of a sell-off day, that probably would be a perfect opportunity to go in in the spot market and actually buy the S&P 500. So that's what this curve is predicting. That you have basically a 70% chance of winning if you just tomorrow morning buy the S&P 500 based on the 20-day moving window for the drift. So that's that. And then you couple that with the information that's in here, and this is the probability distribution of the 20 days. It doesn't fit as well as the 250 or the 60 days because there's less data, right? But basically, what's happening here, if you take a look at the printout that Poseidon does for the S&P, this is why you have to do it in Word, open it up in WordPad or Microsoft Office, and you can take a look at the 20-day PDF. The average is going to be positive here, and with a sigma of this, 1 sigma here. So here we have, it's close to 0, but it's not 0 exactly. This is, remember, drift, not price. And it's log of the log returns. And this is basically saying that it's a little bit skewed positively, and this is the 1 standard deviation. So you can basically say that if the price comes in, and when you calculate the actual drift, it's the spreadsheet would do that for you. If the drift comes in at the 3 sigma level, so let's say there was a big candle that comes in. Let's say someone decided, you know what, I think there's going to be a big push past the I don't believe this, but let's just say that, that there was a trader out there that says, well, there's going to be a big push past 1,900. There's going to be this big candle, all right? That might be enough to skew, let's just say, and this happened in a couple days, that might be enough to skew, theoretically, the drift to the 2.5, 3 sigma range. This is telling me, even though I have a 70% chance of positive drift, I might want to do a quick short because it's going to want to mean revert the next few time periods back to around, a little, around here, a little bit positive drift. So if I'm in the 3 sigma range, short it. If it's 3 sigma positive, short it. If it's in the negative 3 sigma range, long. So that's the way to kind of play, this kind of thing. If you're a technical trader, you don't need to be algorithmic. You could just basically look at the qualitative measure, the quantitative measures, and determine your risk tolerance. If you're a more risky trader, then you would probably loosen up the sigma range that you're willing to trade in. A really risky trader might say, okay, I'm going to just work in the 68% range, which is the 1 sigma range. So if it's a little bit below, if it's trading around here, then I'm going to long it. If it's going to trade around here, I'm going to short it. But that's a little bit more risky. If you're a 2 sigma type trader, then you do the same thing. That's a little less risky. When it's just bouncing around the 1 sigma range, you just stay out of the trade. And then if you're not as risky to be a trader and you're more of a mean reverting, waiting for the big move and then load up a bunch of contracts for a mean reversion, then you want to be a 3 sigma trader. So it just depends on the risk tolerance that the individual is. But again, these aren't the price. The way I'm charting this, it's not the price, it's the drift, the 20-day average drift. When you start getting into intraday trading, then you have to bring down that window really, really small, and you don't want to use 20 days. You're probably wanting to, look at, 20 ticks or 5 ticks or maybe a combination of the two to determine, well, there's some sort of convergence with the PDF, in the 5 tick range versus the 20 tick range or something like that. But that's the basic idea of Poseidon here. It's trying to give some qualitative measure and some quantitative measure, and that can be augmented with technical trading if they want. If they don't want to augment their 2D method, all they basically have to do is just read this and put it into an algorithm, and determine what their risk tolerance is. What kind of sigma trader are they, and it would be able to produce a buy-sell signal. So that's the S&P 500, the way to look at it.
There's some questions here, Paul, about that.
So I can take some questions before we do the oil spread. So that's a little bit more complicated.
Yeah. Okay. So there's 3 questions from Casey. How do you decide it will mean revert? You have a short squeeze, or I'm just trying to understand the typing here. Sorry, Casey. How do you decide it will mean revert, or you have a short squeeze that will go parabolic? That makes sense?
If I understand the question right, usually what happens is a big candle. Then some big candles, and then it'll come back down. It's really more. It's not so prevalent on the day chart. You see it in the intraday. This guy sounds more like an intraday trader. But if you look at the minute, you can see this kind of stuff.
Yeah.
So you got these big moves or gap ups, and then it starts petering out, and then all of a sudden this is where the chaos theory kind of comes in. It climb, it dies off, it sells off hard, and climbs, sells off hard. Here's a nice where it took off. This is where you had the black dots. If we want to use the complexity science method to explain this, you had all the black dots selling more so in a coordinated behavior, and then all of a sudden the composition of the market at this moment in time ended up becoming more homogeneous and mean reverted back. But to try to answer the question, the idea here is that you're parameterizing. I'm looking at things 20-day moving window, not 21 minute moving window or anything like that. So I can't really say, looking at this data here, the quantitative data, to compare it to the 1 minute chart. I have to, because the way it's parameterized, I have to look at a 1 day chart. And what this is saying is I don't think that there are any big candles really that show up here. But the idea is it's drift. It's not price. Remember, it's 20 days of drift, and it may take quite a bit of negative move to try to move down, weight down that drift. So there's the memory of, how do I want to phrase this? The memory of the data is staying with the regression line, even though it's a 20-day moving window, and it won't shake you out. It shouldn't shake you out. So it would be a rare event where you would have the drift in a 3 sigma range. You're most likely going to be in a 1 sigma range. And in those cases, you wouldn't, I don't think you would have the problem. But when you have a really big candle and high volatility, usually those candles that are big, they're usually a sell-off. When that happens, it would start weighing down the drift over a few time periods. Here's a good example here. So the drift is positive, right? So these are all positive drifts, and the weighting down of this, there's a lot of, there becomes a lot of volatility, right, in here, and the market starts to sell off. It's pushing down this positive drift weight. It may sit, but it takes this right here, starts moving the drift to slightly above positive drift, just slightly. You might be a nice positive slope here, but the weight of this data, so now the 20 days are up about right here, the data here plus the data here is making it almost a zero drift, okay? So then it starts climbing up, and all this data starts moving out of the window, and this is starting to equalize, right? And it starts to climb up. So that's why you have the zero, this consolidating area, the last 1, 2, 3, 4, 5, 6, 7, 8, 9 trading days have not done much to the actual drift parameter of the regression. It's going to take a little bit more time to get all this negative data out of the window before you actually have a strong positive drift. But when that does happen, if you are trading in the 20-day window range, it would say, you know what, I should start shorting it because it's been moving too much. But you might want to get that confirmation with a smaller window or a larger window. But that's how I would look at it. The candle, just one candle isn't enough because the way this is parameterized is a 20-day parameter. But if you start parameterizing these surfaces in the intraday level, then now you're starting to talk about short-term opportunity of shorting, some long candles.
Yeah, Casey's confirmed that he's a 1-minute trader. Dave's come back with a quick primer on drift, please. Is the standard deviations away from a regression? You want me to repeat that again? You want me to repeat it?
Yeah.
A quick primer on drift, please. Is the standard deviations away from a regression?
Okay, so there's two parts to this. When you do a line regression, a line is being fitted to data, and it's usually using what is called an ordinary least squares method to parameterize the line to try to get the best fit of that line to the data. So the error or the deviation from the real points to the fitted line is the error of the regression. All right, but when that line is fitted, once the line is fitted, you know what the slope is. So the drift that I'm using in the Excel sheet is the slope of the line. The standard deviation that I'm talking about in the PDF functions is taking the data, it so happens to be the calculated drift of the log returns, and it's doing a density plot, and it's just saying that the probability of the drift of the drift of the return of the logs happens to be 1 sigma for a 20-day parameter, 20 days worth of data. It so happens to be, if I can find it.
Yeah, Dave came back saying,
go ahead. the standard deviation so happens to be 0.00098. I mean, so that's the standard deviation of the data set, not the standard deviation of the line regression.
So Dave came back with saying, yeah, he's got it. Drift equals slope.
Right.
Okay, let's do one more. This is from Casey again, but it's in two parts. It's quite lengthy, so I'll chunk it up as best as I can here. He says, this is back to your U.S. equities. U.S. equities, if you had a choice of EU bonds, U.S. bonds, or EU stocks or U.S. stocks, what would you pick? U.S. companies are more financially responsible and, relatively speaking, less regulated than the other choices. So he's asking about, I think it was part of your other later on, but he was also saying something about we have a supply and demand situation. So there's two parts to it.
Okay, well, I'm going to quote J.P. Morgan back in the 1890s, I think it was around the 1890s. J.P. Morgan, Pierpont, Morgan, the original guy, basically said that you should never bet against the United States, ever. So there's my answer for that one. Now the second part, I wasn't sure what he meant by supply and demand.
If you want to type away again, Casey, on that, and then we'll move on to the next segment. I'm not sure if he's still there. Do you want to retype your question, Casey, about supply and demand? If not, no. Okay, you want to move on? I guess he hasn't responded yet.
Yeah. So it really depends.
Sorry. He just came back. He seems that there's a perception that U.S. stocks are more stable than other options.
Let me give you. This is kind of adds to my personality.
And then just so you know, you just follow up with two more.
Don't bet against America. Just right there. Dude, just look at the screen.
Yeah. Yeah, so he came back, so there'd be more demand for them, and money has to go somewhere. So I think...
Well, basically what's happening, if putting all kidding aside, basically what's happening is the Federal Reserve is saying, you know what, the bond game is over, right? And people are now running, into equities. Now, do you feel safe in the emerging markets? No. You hear all bad news about China starting to slow down. They're not going to have the growth rates that they thought they were going to have. They have infrastructure bottlenecks now, so that people aren't going to be buying cars as fast as they thought they would. And there's issues with degradation of the air pollution and all this with China. Then you look at Europe, and it's you have a war in Ukraine right now.
Yeah.
The EU, it can't get their act together in terms of a one bond market, and the ECB is always bailing out a peripheral nation. So the only one that's got any chance of having stability is England. So, and England doesn't have as large of a market as we do. So I think we're the only game in town, and that's part of the reason why there's such a positive momentum. I mean, when Brian and I were talking about, during this period of time right around here where this V was happening, and with Ben Zeb, I kept on thinking, you know what, it was going to bounce. At the time, I thought it was going to bounce at the 1,800 mark short. It was going to hit the 50-day. And there was going to be lots of shorts, and then it was going to test the 200 and then move up. It didn't do that. It hit the 100 moving average. And if you look at, sometimes I look at the Fibonacci, kind of look at the Fibonacci like that. So when you look at the Fibonacci at around that time period, right, if that was the high point at that time period, not knowing all this stuff, It just so happened that the Fibonacci was 38% retracing right at its 200-day moving average. So I kept on thinking, well, if you're a Fibonacci trader, you should be shorting the damn thing to hit the 200. But this thing's got so much momentum that the shorters are just getting killed. But the thing is this is the beauty of Poseidon. Poseidon's basically saying, even though you're seeing this action going on, and if you longed it at the bottom of this sell-off here, you would have made money, good money, all right? But it's just basically saying that when you parameterize all these moving whips, at least the 20-day, and have some sort of monthly contingency claim, meaning options or futures, in the S&P 500, you didn't really have that much of a game, a game. There has to be more time that comes when all this data starts getting out of the window, the 20-day moving window, if you're a monthly trader type guy, all right? And I would think that those are where all the barrier options are, where people are building up positions is during those periods of time. My gut feeling is that there's some resistance at this 1900 mark, all right? Now this is a technical trader looking at this and then trying to get some sort of confirmation or some data out of the side and see it. But I think this is a signal here that's basically saying, you know what? Even though there's not been that much volatility relative to the 20-day, all right, and it looks like there seems to be a prediction of less volatility because of the direction of the surface. And the CDF, I don't have it around here, the CDF is predicting saying, well, you're going to have positive drift 70% of the time. So there's a lot of momentum built up in this. Now, if I had this data, when Brian and I were talking about this action way back when, this would have said, you know what, there's a low probability of shorting along it. And if just following this sheet right here, this CDF, blindly, and just say, well, it's 70% chance of positive drift along it, it would have made money. Just this one sheet right here. Instead of trying to think my way using Fibonacci's and saying, well, it makes sense, it seems to be going, intersecting the 200-day with the Fibonacci, that's usually a sign that, you should short, and it didn't. It's because there's no other game in town.
Yeah, Casey came back with you have an expanding wedge with a flat top.
Expanding wedge with a flat top.
Yeah.
So he's thinking that this is gonna start flattening out. I mean, these are almost like dojis here. Those are usually signs that something's gonna happen.
Well, he's saying right now, no. He's saying no. It'll break to the upside.
Yeah, right. But that upside may be only 20 points. And the reason why I'm saying that is that I think it's possible. It's possible that let's see here, the options trade.
Yeah, he's saying draw a trend line along the last three bottoms.
Oh.
I'm just looking at the audience here. It looks like we might be losing one or two people.
So you're thinking that? So he's just saying, okay, this is kind of what we just did here for people that aren't technical traders. What we just did here is kind of like making a lower channel, and this is kind of a close approximation of what Poseidon's doing with the idea of drift. So Poseidon's basically saying here in the CDF that there is a high probability, 70% chance of positive drift, independent of doing channels. but that's kind of what that's saying here. And then the PDF is basically saying that if that even this is positively skewed, the average is still positive drift. So if you just read these, just the averages and the probabilities, you could just say long it. If this curve was slightly to the left of the zero, then it should be blindly short. And what probably would happen is that the probability of a negative drift would start becoming more like 0.6 or 0.7. You would see the zero line move a little bit over here, and it would be like around here. If this if this average was around here, so this whole curve was shifted. But this is a big momentum thing. There's a big debate. Is how much more gas is there to go in? But we're looking at day chart here, and a lot of these people are, looking at how to make quick money. We're looking at intraday. I haven't parameterized these surfaces on intraday data. I've been just doing it with V data. But the PDF and the CDF is confirming with the person that asked the question and made the statement that it's probably going to go to the upside. But the question is what is the number of contracts for the option market for puts and calls around the 1,900? And if there's more puts than calls, then there is a lot of fear that it's not going to go above the 1,900. And then that might be confirmation if I did a PDF or a CDF of the volatility. And remember, Poseidon's not calculating that right now, but when I combine the drift and the volatility PDFs together, when you have a big candle, you're going to have lots of volatility. In that case, you might want to, when you read those, you might say, well, when volatility is really high, I want short, and, if that candle goes up. Because remember, volatility, the way this is calculated, volatility goes up when the candle size, independent of going up or down. So you could have high volatility with large candle moves up or large candle moves down. So if there's a big move to try to break that 1,900 and it does break it, there's probably a lot of people that are going to be exercised. So I suspect that there's going to be movement 20 points up, but there's going to be a lot of resistance at that 1,900 mark, and there would be an opportunity to short. And that's kind of confirmed with this MACD and RSI. There's not much more room that this thing could go before it hits the 1,900 mark without this thing curling. But that's just my take on it. I mean, again, I'm more of a currency and oil guy.
Yeah, I guess you might want to move on because Jag's got a question about energy, and you're covering that next, right?
Yeah.
So when we cover that, once you get through it.
Okay. So now here is the current contract for oil, and while that is while Poseidon is generating the oil chart here, we can start talking about a little bit of the technical analysis and maybe share a little bit of information. So let me launch Poseidon here for the oil market. So while that's cooking, all right, what I do is I do spread trading for oil market and the nat gas market. But tonight I'm only going to be talking about the oil market. So basically what I do is I take a look at the direction. So pre-Poseidon days, all right, what I would do is I would listen to what's going on in international news, because this is highly event-driven type commodity. And also look at the overall movement of the market on the day chart, and decide if I think that there's going to be a positive move up, then I'm going to short the spread. I'm going to long the current contract, and I'm going to short the forward, 1 month out contract. So it's a calendar. If I think that the market is going down, then I'm going to buy the spread, where I'm shorting the current month, and I'm going to long the forward contract out, with the 1 month forward out. So that's basically that I have. So the oil market. So what kind of trader is this individual for the oil market?
You asking that as a question?
Yeah, the one that asked the question, what kind of trader?
Who's got a response? No one's responding yet. Oh, spread. Dave said spread.
Yeah. Right. So so he understands that you don't want to you don't want to go naked with the as spreads is it's a good risk it's a good risk tool. It's a good hedge way of doing it. Now, it looks to me that if we have more political risk with Ukraine, then it's possible that the CL contract is going to hit 105. But that starts to this is my gut feeling. This is my personal opinion. If it breaks that 200-day moving average, which it's just kind of floating on it right now. You see here, it's just kind of floating right on it. Then it's gonna sell off hard. If so, I'm waiting for confirmation of it moving up a little bit before putting in a sell spread, or if it breaks, buy the spread. I'd wait a little bit before it's just kind of hanging there, and I think it's really geopolitical. The reason why. Now, if you look at some of the other indicators, you got the MACD. Well, there's already some confirmation of a sell-off, but once it crosses that 200-day, then this thing's really going to curl down, and that's the time to buy the spread. This is at the 50. Now it could go either way. It might ramp up because of geopolitical, and then come back down really quickly. So right now I don't have a position in. I'm just kind of waiting for some sort of confirmation of a little bit more drift above the 200. That skills hopping up here. Then it's going to start wanting to deny that longs, that this thing's going to long. So you'd want to short the spread in that case versus if it breaks the 200, you want to long the spread.
Couple of questions came in. First,
so that's kind of a technical use.
There's a question from Ian asking about if it's a vertical or a horizontal spread.
A lot of the calculator surfaces, there was a little bit of an intermittence with the video, or with the audio, so can you repeat?
Yeah, so he wanted to know if it's a vertical
just repeat what?
He wanted to know if there's a vertical or a horizontal spread.
Vertical or horizontal spread.
That's what I got.
I mean, I do a calendar spread. I'm not really sure the term vertical or horizontal spread. I think I'd know it in a different term.
That's what Dave said.
So basically what I'm doing is that I'm taking the current contract. If I had a position in the market right now, I take the current contract and offset the position with 1 month out. And then close my position and roll it the next month. When it gets close to contract expiration, usually I don't usually wait until expiration. What I do is I try to close it out either 5 to 3 days before, and then just do a rollover.
I don't know if this is related. You want to answer this from Jack? He wanted to know, do you execute manually?
Yes.
Okay. I guess that's all I got right now.
Yeah. No, I execute manually. The intent is to develop something in Poseidon where it's doing the automatic trading. The problem with that is all of my trades right now are pretty much going through Thinkorswim, and we've been playing around with some ideas, maybe going through IB, to do some algorithmic trading, the interactive broker. All right, so in the oil market, same stuff that we have the 200-day oil market. It's got some neat topology. So in the 60-day, here you got positive drift for the log return, negative here. You have the current time around this corner, and you have farther out time in this corner, and you have the volatility of the log return in the z-axis. And you can see that there was, in the 60-day, a lot of volatility and then abated. So here again, it's showing that, well, we went into a trough, and the volatility started climbing up again. And it's possible that volatility will start to increase. When I look at this chart, it's kind of showing that. When I look at, that's a 60-day surface chart with 20-day data window. This is a 20-day surface chart with 20-day moving window on the data. And let's kind of compare them. Let's get an idea of what does it look like, at least at the qualitative level. So here we have more current time, older time, positive drift in this corner, negative drift in this corner, and then obviously here. So as time has gone on, you can see that drift has been going negative, and that the volatility has started to increase. And that what's neat about this state space is that if there was a big move, positive, let's say there was some algorithmic traders that was reading this and saying, well, if it hits the 200 long it, let's just say that was their algorithm. This state space is kind of predicting that volatility would rapidly increase, because this is kind of like the predictive state space of that move. The surface, though, the way this is, it's at the low point, so it kind of is truncated. It's hard to know what the state space would be if there was a big short for the oil market. So at least in this data, it's kind of predicting that, you know what, this probably is a long situation. So I'd want to short the spread and not long the spread. In other words, that this curve here is going to move up. And it's probably going to move up rapidly. Volatility's going to ramp up. That's really important for people that are doing the options market and the spread trading. We want to see stuff like this because when this stuff happens, that means the spread between the two different contracts is changing. Hopefully changing in the direction that you set up the trade. But the way this is looking, it's looking like, well, you know what? Even though there's been so much negative drift here, and a lot of this is kind of parameterized with some of all this crap that's going on. But there might be a good opportunity here to long this kind of commodity. Now let's take a look at the 20-day PDF. The 20-day PDF is showing, again, average negative drift, which we saw here. You can see that there's this big move, and you see all these negative points, so that just qualitatively this is negative drift. And here we go. That's 60-day, 20-day PDF. All right, so the 20-day PDF is showing that it's skewed to the negative. So probability-wise is that it should be a negative number that's printed on average positive drift. So this is telling me, you know what, there's higher probability of lower numbers than higher numbers. So if I was just to read the PDF, then I'd want to actually short this. Well, compared to here, if I look at just the state space, it's looking like, well, it's been negative for a while, maybe I want to long it. So this is kind of telling me, well, maybe this is going to be longed, all right? The volatility is going to increase, and it's going to be moving more, even though it may be negative drift, it's going to want to weight it less negative. So that's kind of confirmed here that it's been playing around in this space for a while. So maybe I want to start longing it. So that's kind of the way I'm reading the PDF. Now let's look at the CDF. The CDF is, where is it? Okay. The CDF is saying that the probability of it being negative is 60% chance. So there's only a 40% chance of a positive drift. So that seems to say that there is, I'm getting some different signals here, but it's basically saying to me that I have higher probability if I have 20 days in a contract that it will have negative drift. So that would mean that it would be selling lower, and it probably will break the 200. So by reading all this data, the MACD coming down, the strength of this is at 50. Looking at volumes, I don't know, I don't really see any really positive signal here for the volumes, but the CDF is telling me I have a high probability of negative drift, so that's probably going to mean more lower candles. And the PDF is telling me the same thing, that I'm skewed and probably wait for a couple big candles, break the 200, and then long it. So if I was to place a trade right now, I would probably short. If I was reading the way I'm reading Poseidon, I have probably a higher probability of the next few days to be negative than positive. Um, but if there was a big candle that breaks the 200, wait a couple days, then long. If you were doing doing like a future day trade kind of thing, some people do that, with tight stop losses. That's their risk. That's their risk tool to manage risk. If you're a spread trader, you're usually holding the position for longer. This is basically telling me I'm probably better off buying the spread than shorting the spread. So that's how you would use Poseidon to do spread trading in the oil market. Again, Poseidon prints out this sheet. It's easier to see it if you open it up in WordPad. And if you look at the 200-day, it's saying, well, you got an average that's negative, right? And the drift, even though it's slightly, not the drift, the sigma. So you can, if you want to be a, 1 sigma trader, 2 sigma trader, 3 sigma trader, you can just say, well, when the drift, goes within that range, I either buy or sell, depending on what side of the distribution curve you are. But just reading averages, it's looking like it's going to sell off. So if you were an algorithmic trader, you could read this text file, and you can basically say, all right, the next print from the next price, calculate the log return of the previous price, calculate the drift, which is just a line regression, and the slope of the line regression. And then if that line regression slope, the drift component, happens to be in your sigma range, then you determine the long or short position. So you can use that in an algorithmic manner too. So Poseidon doesn't algorithmic trade, but you could use Poseidon as a means to use it as a buy-sell signal, or to get data from it and to pipe it into your algorithm to do an algorithmic trade. That's where it's at right now. So if there's any questions.
Oh, there's 2 questions from Clay, 2 questions from Jack. I'll do Clay first. Buy spread means buy the spot and sell the 1 month out future.
Yes.
Or vice versa. Okay. Or go ahead.
No, basically the spread trading in the futures market is you're buying the current. What I do is that I buy the current contract and offset the position with the 1 month out. But some spread traders don't do that. They might actually do buy the current and maybe do 3 months out. But I don't think you get a whole lot of activity, at least in the energy market. A lot of the action is between the current contract and the rollover into the next contract, because you got these hedgers, not speculators, that are trying to protect their position because they actually are delivering oil, and they want to protect their current inventory that they're delivering. I think that's the main reason why there's a lot of activity in those 2 contracts. But theoretically, you could go out farther, but I don't think there's that much action out there.
Yeah, I think you've followed up with Clay's second question, but Jack got a couple questions for you. He asked, how have you found any practical use in using options on futures to forecast volatility versus standard futures contract?
I don't think. Well, it's an interesting question that they're raising here, and that is, do you trust the Black-Scholes model to basically the implied volatility, basically, as an indicator of true volatility? People that use Garsh would say no. Implied volatility is too non-stationary. It's not a stationary data set, and therefore it may be market sentiment at that moment in time, but it's so fleeting that it may not really give you really good telemetry of the market. And that's why a lot of algorithmic trading is going in the stochastic volatility method or the Garsh method or something like it. I would say you could, if you believe in implied volatility as your metric for volatility, then yes, you could use the option market. I don't believe it. There are many times where implied volatility is below historic, many times where it's above. So it's a non-stationary data set. So I'd rather use moving averages, or simple moving averages, or weighted moving averages, and maybe coupling that with Garsh modeling or some sort of stochastic volatility modeling as my volatility metric. But if you need a quick and dirty, at that moment in time type volatility metric, then implied volatility is close enough. But when you're starting to think about, well, I'm parameterizing surfaces or parameterizing certain curves or models with a certain moving window, I'm not really sure if implied volatility is the right one. I don't think it is.
Jack's also got a specific question. What do you think of Brent versus WTI, and do you trade ICE or CME only?
CME, and it's just the WTI.
Okay.
I don't do Brent.
Okay. William Cottrell asked the question: as a nat gas trader, how would the possibility of the U.S. supplying liquefied net gas to the EU affect your immediate market position?
Well, I mean, the thing with nat gas is we do have a lot, primarily because of fracking, and so we have an oversupply. That's basically the reason why, if you look at the natural gas market, the natural gas market, it's almost double the price than the domestic market. What that basically means is we have a lot of supply. The problem with LNG is that there's not enough ports for us to export the commodity out of the country, and enough ports in Europe to accept it. So it's really a bottleneck in terms of infrastructure. But if it did, and it takes years to build up these ports. But what it would be is a hegemonic move between the United States and Russia. Russia has a lot of nat gas going through Ukraine. And if you could LNG into Europe, you're basically checking the Russians. Germany wouldn't need the natural gas for their production, and they could just import it from the United States. Our trade deficit would drastically go down. But what would happen is that the supply, the oversupply of nat gas would start to diminish because we're selling it to Europe. And then probably the domestic price would start to go up. So in that case, that's a screaming buy for that commodity. And there would be a lot of volatility in that market if or when they start exporting LNG. Instead of $4 or $5, you're probably looking at $10 or $12 so of natural gas. I forgot what the unit is per unit, but right now it's trading around 4 something, I think. Gas, NG. So right now it's at 4.6. All right. Now if the international market is around 12, you can, and this was during, the real cold days in the East Coast. It spiked to 6. That was just a cold spell. You can just imagine if it was a geopolitical major move, and we were exporting LNG regularly, nat gas would easily hit 12, easily.
Jack's got a question. What do you think of technical analysis like stochastic bands, etc., or do you prefer to stick to modified moving averages?
Well, trading is an evolving thing. You know, I'm moving more towards this realm of algorithmic, graphical kind of trading. As a technical trader, I like the 50-day, the 200, let me say the 50 period and the 200 period moving averages, simple moving averages. The MACD just to get direction, and the RSI to get strength. As you can see, I'm moving more towards, okay, I want to see this. I want to see the market in 3D and get a little more idea of volatility. What's the possibility of the volatility? What's the actual drift? These curves don't give me drift. They don't really give me. They sort of give me a drift if I draw a linear line, but it's hidden. And some of this data kind of, you get some weird things out of this to read. Plus, this doesn't give me probability distributions on the next. What's the probability in the next 20 trades or the next 20 days? How this is going to perform, with a statistical significance. What Poseidon is doing is giving you that statistical significance. So if you want to trade with statistics, you can. So I'm kind of like morphing my way of trading. It's kind of like a combo between. Technical trading and this topographical trading, or more of a quant trading kind of method. It's kind of a hybrid.
Anybody else got any questions? I got nothing queued up right now. Anybody got questions? We're up to 2 hours now. Do you think we'll go beyond 2.5 hours like last week, Paul?
I don't know. Depends on the questions. I'm just curious. What was the total number that we hit for attendance?
We peaked at around 23.
23.
Yeah.
Okay.
Oh, we were supposed.
No,
we were.
one just left.
Well, yeah. I already got notification. A few people left. They were just had to go or whatever. But we want to do a survey. How many of you guys prefer Wednesday nights versus Monday nights? Let me know. Just give me a Monday or a Wednesday of your choice. Anybody out there?
As people start to cue in with that question, the next phase, which is this thing that's the next phase for Poseidon is to do the PDF and the CDF functions for the volatility. I think in terms of option traders and spread traders, that's a more important metric than the drift. I think the drift is a little bit more of an indicator of momentum, of direction. But the volatility is probably the more important metric.
Yeah.
I'll have that uploaded into this Dropbox server thing for everyone to download, whoever wants it. And again, this is free. I mean, you can go ahead and play around with it, and always email me or whatever, and contact me if there's something that you would like to see. Something specific, maybe a certain moving window, whatever you want to experiment with something. I'm happy to oblige.
Yeah, I mean, it's really helpful for Paul to understand what people are wanting or needing. So get in touch with them. Do you want to put your email into the chat box, Paul?
Yeah.
Just make sure. I think you'll have an entire audience, or just the staff like me and you. So just make sure at the bottom you pick all entire audience. So far on the survey, I've got two Mondays. Anybody want Wednesdays over Mondays? Just type that in. And just so for you know, Paul, don't speak out your email at all. Just do that. It'll be on YouTube. Yeah, I'm just posting your email. So in the chat box, you have Paul's email there. So if you want to grab it, get in touch with Paul directly, because it really helps him out. So Dave just came back. Monday mornings, I have a no trade rule on Mondays due to statistical improbabilities of making dollars. Good one. No, we try to keep it at night. Anybody else got any questions or comments for Paul? This is pretty good. I mean, I learned a lot tonight.
And again, this is an evolving thing. The people that have been watching this, during the early development, it's evolving.
Yeah, I think it's going to turn into something really fantastic.
Yeah. So, again, the next thing is, basically get the statistics for the volatility. I did the statistics for the drift. And then the next phase is to start building up the server, to start, because this is going to kind of move into more of an artificial intelligence kind of realm here.
Two comments came up. Dave asked, what help do you need to make Poseidon better?
Well, that's, the goal of Poseidon is to move it towards, I'm going to show you a PowerPoint here. Again, I'm moving it towards this law of periodic fitting, using, out of the money options is another metric. Hazard rates is another metric. So coding that. Another big advancement would be the actual streaming of the surfacing. That's a really, really, once it's done, that would be really cool. But I think we're really pushing the envelope of technology here.
Not really. Just not. It won't work on commodity hardware. That's for sure.
But it's just once I get to that level. But these are the big areas of development. A little bit of the granularity of those areas of development are here.
Yeah.
But so there's always the coding side, the algorithmic side, but then there's also the kind of like the beta testers, the real traders, and how to use it. And they may see something that I'm not seeing because of my biases, with the way I trade. So if someone is using Poseidon alongside the way they trade, and they see something they want, let's say they're an intraday trader, they may go, well, Paul, I'm an intraday trader and I want to take a look at a certain type of commodity. I'm trading, let's say, JP Morgan, and could you provide some information on JP Morgan through Poseidon? I would build that up for them for free, no problem. And, and then just tell me what sort of moving windows they usually trade under. And then, I give them the data, and then, hopefully they see something useful out of that. What kind of moving window would they like to see? Is it a 14-day moving window? Is it a 10-day moving window? Is it a 5-day moving window? What do they want to see? Drift in price instead of drift in volatility? Do they want to see volatility in price instead of drift? What sort of three-dimensional cube would they prefer to see? I'm looking at it from the perspective of spread trading, and directional trading and volatility. That's kind of the direction I was going after, but that's because of the style of trading I do. People that are a little bit more in and out with the trades, they may not really care about drift. They may care more about maybe actual price, because it's maybe a little bit more psychological. So maybe it's price and just volatility. But people that are actually trading, they want to use Poseidon next to the system that they're using right now to kind of experiment on how these surfaces are giving you telemetry of the market. I think would be very useful for future development.
Ian's come back saying it's very impressive, thanks, so getting kudos already. Anybody else got any comments or questions for Paul? It's 9:03 right now, just over 2 hours. Dave says, is there a community for Poseidon as like GitHub or at sourceforge.net that we can join to coordinate?
I mean, we could set something up. I don't have anything, really formal.
Well, I have open source projects on SourceForge, so we can coordinate that, Paul. But
okay.
part of the problem is they'll want source code. It's part of their mandate. It's open source, right? But we could probably put together some kind of facility, or just use Paul's site as is.
Well, yeah, I would prefer to use my site. I haven't gotten to the point where I'm opening up the code. I'm willing to give the software free. I'm willing to develop it to specific needs of traders. But in terms of actually giving the source code out, I think that's a little bit further down the road. I'd like to develop the software a little bit more, get a little bit more features in the software.
Well,
and then I see possible issuing the DLLs or some sort of connection of a particular trading platform into Poseidon, using some sort of sockets or whatever, some sort of connection between it. But I haven't gotten to the point where I'm opening up the source code.
Yeah, we can always use the forum as well that I've got on my academy, and just use that as a form of communication as well, if you want. Bart came back with a question. Hey Bart, for strategy of selling spreads in options where we want our positions to expire. Just trying to understand the typing here. Okay, let me start again. For a strategy of selling spreads in options where we want our positions to expire worthless with as little volatility as possible, how would Paul handle this subject with his Poseidon algorithms?
Okay, let me try to understand this.
You want me to say it again?
Again, I'm currency and spread trader in volatile markets, right? So, currency and the energy market are volatile markets, but it's not options. So the option world is a little different than future world. But because Poseidon does heavily graph from the perspective of volatility, I think that Poseidon can provide valuable information either in the surface or through the PDF.
Oh. Hang on, folks.
Yes. Now to the specificness of the question. Now they have a losing position. If I understand this right, they're having a losing position, but they don't want to sell it yet because of the dynamics of the volatility should make their losing position less right before expiration. Is that true?
That I'm not sure of. Do you want me to?
Yeah, I'm trying to understand the dynamic of the question.
Yeah, so Bart, if you want to follow up with that. I got a question from Ian, if you want to handle that first before we hear back from Bart. Ian asked, the optionslab.com gives some visuals for 3D on different option Greeks for all option strategies. This lecture helps me understand the concept much better. So I guess it's a comment. So just something to think about, I guess, Paul. Still waiting for you, Bart. Anybody else got any questions at all? Oh, Bart just followed up here. Okay, so he says there is a certain strategy of trading options called selling spreads, and it's profits when options expire worthless.
Okay, I get it. I get it. Okay, so I think what he's saying is he's actually selling an option, and that if you have low volatility, then you're collecting the premium, and you don't have the risk exposure. Well, let me rephrase that. You don't have the loss when you're selling the option because the volatility is really low. So I think as an option trader, I think they would think, okay, if I'm selling options, I don't want high volatility. So I want low volatility. And if I'm buying options,
Yeah, he said exactly. We want to.
so Poseidon is perfect for that. Here's an example. Let's say you are, whatever the commodity you're trading, okay, or not commodity, but let's say you have some option. This happens to be oil. But let's just say you have this topology of your trading, all right? This is the current time, volatility, and the drift, right? Okay, so this is 60 days, all right? But let's just say that you had some option in the market around this time frame, all right? You don't know all this stuff, all right? Because this is in the future, all right? If you sold options near the peak of whatever the surface is, because of averages, and let's just say it was a 3 sigma event, whatever, you would want to sell the option because volatility is going to start coming down. So if you sold the option here, let's say if you sold some sort of spread or whatever, and over time, let's say this was over a 2 months or whatever, you would be making money. You collected the premium, you had low volatility, so you have low risk, and then you close it out, and then bam, you've made your money. Here, in this case, let's just say this is near a statistically low hold period for volatility. And let's just say the PDFs and the CDFs were saying, well, there's higher probability. Let's say a 70% chance of higher volatility. Let's say if you were an under, you could say, well, I don't want to sell, I want to buy. And the volatility kicks up, and then you're making some money.
It sounds like Bart's pretty happy. Yeah, he's saying super, super, super. You got yourself another winner, Paul.
All right. If he wants to try the software out, if whoever wants, again, you can download Poseidon for free, all right? But if there's something that you're trading, something specific that you need parameterized, I can do that for you. And if you want me to parameterize different window sizes, either for the surface or for the data that's in the Excel sheet, for a different 20-day, maybe you don't want 20 days. Let's say you want.
Hang on.
Different window size, and I'll develop it specifically for you, and then you can do a download and take a look at how you trade and look at the services that way. But the intent is that once I build up this larger database, you can just query the database of whatever you're trading, bring it down at whatever window size that you want, and then Poseidon will generate the surfaces, the PDFs, the CDFs for you, and then you can use those for your trading. And then it would also generate this text file for people that are doing algorithmic trading to read off of.
Bart came back with this software seems to be ideal for trading options with certain strategies. Not bad. Who's got any other questions? Comments for Paul? Oh, Ian's getting excited, I think. He's asking, maybe off topic, but it does seem counterintuitive to see current parameters on the left. I'm not sure what I'm not sure what he means by that. Ian, if you want to follow up. You mean on the plots? Ian, if you're out there.
I mean, again,
Yeah.
the way this is set up, I create all these different windows because a lot of the traders that I talk to and what I do personally, I have a lot of screens. So, I'm moving these things off the screen on, multiple screens and comparing it to charts like this, right? And I'm looking at 5, 6 different screens that may have 4 different windows on each screen to compare. So it's not, this software is kind of developed for a little bit more advanced trader.
Yeah.
That that has multiple screens. It's a little harder to do it on just one screen. So it's not like I'm building a GUI that has all this. I want them to be in individual windows for these multiple screen type traders.
Well, actually, I understand what Ian's saying here. He came back and says, I mean, you are reading the surface from right to left, but that's how MATLAB generates it, right?
Well, it depends on how you rotate it. The way this is working here, it's kind of tied into the way I'm reading this, because the data, the top data here is the nearest close, and then way down at the bottom is a year ago, right? That's the reason why. If I flip it, it should be the way you're looking for.
Yeah, that's what I got a comment
And
from.
maybe that's just an aesthetic. That may be just an aesthetic thing. That's just the service provider of the data I get it from. That was the format it's in. But he's got a good point. I mean, maybe it makes more sense to just append the next record.
Yeah.
So when I develop it in SQL Server, I think it'll probably be more in line to what he's looking for.
Yeah, he said he can.
I'm probably just going to append at the very bottom of the table, not the top of the table.
He's saying it can rectify in Excel. And Steve said time usually moves sequentially left to right on charts. Could just make option to reverse the sequence.
Yeah. Okay. I see.
Yeah, I mean, from a programmatic standpoint, that's
but,
pretty.
But the thing is it's the way you rotate it too. Think about it.
Right.
Watch how I'm doing as I'm rotating. See, now it's right to left.
Right.
Or left to right. So it's the way you're rotating it.
Yeah, he's agreeing. Ian's agreeing. 3D. And Steve came back. I wonder if the current day's curve of extreme left is painted, in quotes, if it will stay the same thereafter. Does that make sense?
Well, what's going to happen in some of the future development we're kind of playing around with is that, as you saw, to generate all these surfaces at the same time takes some processing power. All right, it may make more sense for some menu to be pulled up to say, I just want the 20-day instead of the 60-day.
Oh, hang on.
A purpose happen is that when a new point is created, when this starts to become streaming, instead of just parameterized based on day data, but as the ticks come in, this thing starts to parameterize in more real time. Again, I say more real time, it's more like quasi real time, because it takes some time to generate the surface. So the tick changes, it reads it into the surface, and it reads it into the database, and it reparameterizes the surface. And what you'll see is that if the point starts to move down, then the potential state space, the probability state space will start to curl. This here is based on the memory this sonic surface. So that means being parameterized. It's being parameterized by kind of like 2 waves within the surface, not just 1 wave. So it's taking the old history here, and the volatility started moving up, and this is kind of this is the smoothness of it. All right, and the volatility is moving up and trying to match these points, and because there's some volatility, they're slightly higher than some of the other points over on this side, so over here, over these points here, that it naturally wants to curl the normal, the vector normal of the surface is pointing a certain direction, and it's forcing this extrapolation of the surface. So as the data starts to come down here, this curls, this will start to curl.
Okay. Steve's got a comment.
You know,
Go ahead.
no, and so basically what will happen is as more points gets created, these surfaces start to curl, and when you start to see that curl, that's telling you, well, you know what, I probably have hit a volatility peak, and that I want to actually, if you're an option trader, sell the volatility. But you need a few more points to confirm the curl.
Okay. You there, Paul?
Yeah.
Okay, I got a comment from Steve. Won't the surface look like you are stretching a rubber sheet?
Well, no, because it's a moving window. So what's happening here? What's happening is this point comes out, and this kind of is recalculated. So the information, this information drops out,
Yeah.
and new information comes in that kind of adds to it. And this is like a moving window.
Yeah.
That's kind of the reason why I try to look at this data in different frames to get an idea. So this is the 20-day, and here's the 60-day. All right. So here's the current time. Here's old time. So we had high volatile situation in old time. The current time it's lower volatile. Here the whole theoretical framework here is that depending on the window, the surfacing window that you're looking at, there's memory of volatility that is going to affect future volatility. That's the premise of the premise. That previous volatility does affect future volatility. And at least in the 60-day window, this future volatility, or this past volatility, has somewhat of a memory, and it's created this surface and saying, well, at least in the 60-day area, because of the way these surfaces are, it's extrapolating a little bit higher up. So at least qualitatively, this thing might be moving in a higher volatile situation. But if I look at the 20-day, which is a tighter type frame, so it's taking this space and looking at it in higher resolution, probably going to drift, and it might not be so volatile. There might be, it might be consolidated. But to get the confirmation, I got to look at the CDF and the peak.
Steve,
So that's why the reason why I'm looking at a different I'm looking at different windows here. Trying to get an idea of what was it like 3 months ago. What's the volatility surface 3 months ago, and then now what's the volatility surface for just 20 days, of 1 month of trading, and then I make my bet. But you can apply it to, it doesn't have to be days. It could be 20, 20 minutes versus 60 minutes of data.
Steve came back with maybe I should ask what happens to the left edge when data drops off on the right edge.
Well, yeah. I mean, what's going to happen is that that the surface is going to parameterize. So this data is going to pop out, right? This data is going to pop out. This data point is going to pop out. A new data point is going to pop in, and then it's going to reparameterize. Now, in this case, most likely, you say here's a good example. Imagine this point not being there. This last point here. All right. The reason why these surfaces came up was because that point is there. Remember, the way I'm parameterizing the surface is called interpolation between points and extrapolation in non-pointed areas. So it's producing a theoretical state space in non-pointed areas, all right? And it's interpolating two pointed areas to try to create do a surface fit to those data points. But here, as the point pops in, this surface pushes up. So if the next point was way up here, what would happen is the volatility would increase, which would make sense because the volatility would increase. Let's just say that we had a huge positive drift. All right, let's say this. All right, it's most likely, because it's a big move, it's most likely going to have a higher volatility. So what's going to happen is, let's say that point is way up here. The next parameterization, it'll interpolate to that point, and the vectors of the edge of the surface will readjust and extrapolate out. You can kind of visually see what's going on. You can imagine these points not being there, and you wouldn't have these dips. It would be a little bit smoother. The dip is formed because this point is there. It's interpolated to that point. Now you see the state space, the potential state space between those 2 points. So it's kind of like bootstrapping almost between points.
We got a comment from Ian. Will be interesting in the U.S. stocks weekly options too, which are becoming more volume. I think he meant more volatile.
Weekly stock options for the S&P 500?
I'm going to assume so. Ian, if you want to clarify there.
I'm curious with Ian, does he trade the weekly options that are a month out, or does he trade and roll over weekly the options?
If you want to answer that, Ian.
Because it seems like there's a trend to do weekly options instead of monthly options. But I'm curious to know if option traders are going for weekly options out. So they're really buying a month far out in the option, but they're really only buying weekly options and monthly options.
Yeah, I'm not getting. Oh, here he goes. Trade monthly options, but on Apple, say weekly options dominate.
See, my take is, it just seems as though weekly options would add to the probability because the expiration is quicker. It would seem as though you would lose money more often than if you had a monthly option, or at least a weekly option that was 4 weeks out. You have more chance of getting it right. But maybe I'm wrong. I don't know. I'm trying to apply it more like the futures market for their monthly contracts. It just seems that I don't know of anyone that makes money day trading options. It seems like it's not something that lends itself to day trading or quick trade. It's more of like a bet for the month, not for the next day or so. So it seems like the time frame would be too volatile.
Well, Ian responded with Elgin has pointed short butterfly, I believe, on AAPI is more successful, contrary to theory.
So you're saying that it's depending on the option strategy you have, it may make sense to do weekly options versus monthly options.
Well, he's saying long the body, short the wings.
I see.
Crow does not trade that way, or crowd does not trade that way.
Oh, so he's betting against the crowd.
Yeah.
So he's more of a contrarian type of trader.
Sounds like it.
See, I would think that short duration, you'd want to go with the crowd because you're playing momentum. Usually the ones that are contrarians, they're more like Warren Buffett types, more long term.
He came back and said in an instrument which makes short term moves, he is just playing. Or sorry, he's just using ATR. Make sense?
Sort of. I mean, he sounds more advanced option trader than I am.
Yeah. I don't.
I mean, my experience with options is more on the order of, okay, you're buying into the spot market and you're hedging with an option, or you short the spot.
Well,
Spot market.
I mean, I could.
That's the kind of strategies that I know of, but not got butterflies. I've played around with a little bit of, straddles, using straddles, but doing butterflies or inverted butterflies or three-winged butterflies, whatever.
Yeah.
And it's just, it's a little bit more advanced stuff that I don't have that much experience with.
Well, but he's followed up with he does not stop at strikes and does not keep still.
It seems as though he's really tied to this volatility, though. For him to make money, is it that he wants it, he's looking for that volatility spike?
Well, I mean, I could bring in Ian. Ian, if you're available via voice, let me know, and I can definitely bring you into the conversation. He's saying got off topic, was really wondering about the 20-day and 60-day, but say short-term 7-day. And then Ian's can't go online. It says past his bedtime, meaning he's probably got his wife or something beside him. I'm assuming.
Yeah.
But Bart asked a question as well, if you want to.
Yeah.
Okay, Bart came back. Which time window is dominating in Paul's analysis? Is it 60-day or 20-day window?
That's a great question. For the way I trade, for the spread trading, the 20-day I think is the most important. The 60-day gives me a little bit of what the market history was the last 3 months. So it's just kind of like the 60-day oil is more historical, just to get a feel. Am I in a low period in volatility, at least in a 3-month window? And in this case, yes. What I'm really looking for, because I do spread trading, I'm really looking for what is the next move, the next few days for a month contract. And I want higher volatility, and at least confirmation on some sort of drift direction. So for me, it's really the 20-day that makes the confirmation, or like it makes the indication, the trade indication. The 60-day is really just I get a relative reference point in terms of 3-month volatility. I'm thinking though that I really want to look at the 10-day window too. I haven't gotten to that point yet, but I'm thinking that I want to parameterize a surface that's 10 days. The question is, in that 10-day window, do I want 20-day moving average data that's in an Excel sheet, or do I want maybe 5-day moving window data on a 10-day parameterized biharmonic surface? So I'm playing around with the window here, but right now the most important thing for the oil is the 20-day.
Anybody else got any questions? We're breaking our 2.5 hours from last week. I'm gonna maybe not comments.
I mean, is this does this help people?
Oh, I think it does. I think it does.
I'm kind of curious on, does it give them some better insight on how to maybe trade and
Who's got
how to use these more advanced technologies?
Who's got a yes for Paul on that? Is it helping you out? I mean, we're down to 10 people, right? And I've noticed that we've probably gone through about 30 people so far that have come through this webinar. Okay, 2 comments. One from Ian. Very useful pinpointing. Bart says, I like it very much and would like to dive in, with a smiley. So there you go.
All right, so it sounds like he's gonna download the software and use it.
Yeah, man.
Do
I think so. Like we put Bart and Ian, we've put the links in the chat box. Yeah, Ian says we'll be downloading too. Absolutely. So yeah, you guys got the links in the chat box, and if you want to directly get in touch with Paul, his emails in the chat
right,
box.
and if there's a moving window, right, and if there's a moving window that you want to see that Poseidon's not generating for you, or a certain commodity, just let me know, and I'll give you that data. I'll get it to you.
Yeah.
Because I want to understand what other people, what the consensus is, and what sort of windows people would, want to see for option trading or, day trading.
Okay, Ian says, thanks, 10 days sounds good too. Jag came up with a question. It's more technical. I don't know if you can answer this, Paul. If not, let me know. Have you thought about building larger models with C++ or Java on Linux for big data?
No. The reason why I'm not a Linux guy. I'm more of I'm technically more of an Apple guy than a Windows guy. But I'm pretty much gonna stick with a Windows platform, Apple platform, or an OS kind of platform, OS X platform. I'm just not a Linux guy. But there will be this migration of Poseidon into C# and using DLLs to streamline this thing and to speed it up. But right now there's just so much testing that I'd rather spend the time finding out the right windows, the right right structure of the database, the right GUI, the right set of functions within Poseidon. And once that's all said and done, then I'll probably move into streamline it into like C++ or a C# kind of environment. But I'm not going Linux. I don't know.
Well,
I'm just gonna try to focus on what I know. I mean, I'm not, it's like trading. You focus on what you know.
Right.
You don't trade everything. You just trade what you know. I'm just trying to design the Poseidon in the realm that I know.
Anybody else got any questions? Doesn't look like it. 2 hours and almost 40 minutes. Wow. Paul, I'm stunned, blown away.
I mean, this is it's been something that's been evolving, and it's gonna, the next big jump is gonna be that SQL Server database.
Yeah.
And then the jump after that is the quasi real-time parameterization of the surface.
Yeah.
The ticking.
Ian said, good audio and video and content, many thanks. Hopefully we'll get a video on YouTube this time around. Anybody else got any questions? Could be a wrap, Paul.
Okay. All right.
Are you going to do anything? Sorry, are you going to do anything for next week or all, or?
I don't have anything planned for next week. I probably should, do a little bit more research.
No problem. Well, I mean, what I...
You know, when I do these, you know, I want to just be able to share, you know, original content, you know, some new content.
Yeah. Well,
you know, so this next big jump is going to be probably more on the server side.
yeah.
More, and I can explain how I'm doing it. Maybe I can get some, you know, feedback when I show it. But I'm not ready for another webinar right now.
Yeah. No, I mean, what I'll be doing next week, I'll be doing the pairs trading one with the Excel, the spreadsheet, and I just put up interactive brokers and integrating it with SQL Server, so I can do a presentation next week on that, and then we'll coordinate after that. But a couple comments came in from Bart. He said thank you, and I really appreciate the generosity of Paul. Steve came back and said more questions can wait. This is a very interesting presentation. Thanks. So yeah, next week I'll do the pairs trading if you want, and with the Excel, and as I said, with the IB and interactive. With the SQL Server. I already have 3 videos on it on the YouTube channel. So I'll put in the chat box just now the YouTube channel, the Quant Labs. The last 3 videos are exactly those demos. Anybody else got any questions or Zen1, I hope I got your pronunciation right. Thank you very much. Great presentation. There you go, Paul. People like it, as usual.
Thank you.
This is awesome, dude. This is huge. Anybody else got any comments, feedback, questions? Otherwise, we'll call it a night. And we'll be back. It sounds like Monday night's what people want. Again, anybody want Wednesday night over Monday night? Clay says, nice webinar. Thanks, Paul. Anybody want Wednesday night at all? I think we stick with Mondays, it looks like, Paul.
Okay. Well, I just wanted to say, you know, thank you for everyone that attended and the ones that stayed on for, you know, the 2.5 hours or so.
Yeah.
I appreciate it.
Yeah.
It helps me a lot.
Yeah, I mean, I'm learning a lot from you as well. So, I mean, that's what this whole thing's about, just learning off each other. And even these guys are bringing up amazing trading ideas as they ask questions, and my head's already spinning on some of them. So, that's a good thing about it. Anybody else got questions? It's us who appreciate Paul. That's from Bart. That's with a smiley face again.
Thank you.
Anybody else got any comments? If not, we can wrap her up and maybe see you guys next Monday night. I'm hoping, crossing my fingers, this will go up on YouTube tonight. Thanks again, Paul. I mean, this is awesome. I mean, you do not disappoint. That's what I'll say.
Well, you know, just wait. I mean, it's going to get more interesting.
Yeah. I mean,
like I said, you know, this thing's moving towards an artificial intelligence thing here.
Yeah.
Once you start seeing the correlation studies and stuff.
Yeah, and if
you got that.
And if you can even get it as close to real time, I mean, you got something really special.
Right.
Anybody else? Questions, comments, concerns? It doesn't look like it. I guess we can wrap her up, Paul.
Okay. Well, just thank you everybody for attending, and see you next go around.
And next week we'll try to break it 3 hours.
All right.
All right, guys and gals. I think we're all guys here. Thanks for coming out. We'll hopefully maybe see you next Monday night. Keep your eye out on the meetup. Thanks again, Paul.
All right, no problem.
And we'll have a good night to all, or a good day wherever you're at. All right, man. Have a good one.
All right, bye.
There, bye.